investor friends, I'm Michelle Markey, and today I'm going to share my key takeaways of what I learned from Mohnish Pabrai's talk that he gave to Brown University students on August 2nd, 2021. And some of the highlights include Mohnish Pabrai's thoughts on some great businesses and investors like Warren Buffett and Charlie Munger, and what the investment climate is like abroad, and also what you should do before you start a fund if you're thinking of starting an investment fund. And with all that, if you enjoy learning from some of the greatest investors like I do, I'd love if you could please like and subscribe to my video and YouTube channel, because it greatly helps out with sharing my content with others who are interested in the same thing as you are, and I greatly appreciate it. Thanks. The first key takeaway is when Mohnish Pabrai said that the best ways to allocate capital as a business are to, number one, have an internal engine that spawns businesses that generate high returns on equity. And I'll get into more about spawner businesses in the second key takeaway. And the second thing to do, if you can't do the first option, is to buy or invest in other businesses or assets. And then the third option is to issue dividends or do stock buybacks. And he said that buybacks can be powerful if they're done at modest valuations. And something like MasterCard can mostly just do buybacks because they generate plenty of cash flow, but they're not able to deploy that capital in many other means other than to buy back their stock. And then he said that in Berkshire Hathaway's history, they've almost never issued a dividend. Like, they maybe had a dividend once where they issued a 10-cent dividend, and Buffett said that he must have been in the bathroom when the board of directors decided to do that, because it seems like Buffett was a little bit embarrassed that they even issued a dividend. And as we can see, because Berkshire Hathaway has not issued dividends and instead tried to reinvest the cash that they generated, they've been able to be way more successful with that strategy. Key takeaway number two is spawners, that are monopoly-like businesses that lead to new businesses spawning from the original. And Mohnish shares the example of the India Energy Exchange, which spawned the India Gas Exchange, and they have tremendous profitability and high operating margins to the tune of 80% before tax and then 60% after tax. And that's amazing. And as they scale, they have limited options of what to do with all the cash they're throwing off. Like, they can either issue dividends to shareholders or do stock buybacks. And then he also talked about the example of Tencent, where they have a high return on equity business development arm, where they have thoughtful private deals where they're reinvesting tens of billions of dollars of free cash flows. And then he said that they don't tend to want to have large stakes when they're reinvesting this money in certain companies or ventures. And that leads to having incentives for the team to perform. And that's been a very successful model where they've had 15 to 20 unicorns as a result. And then he also said how Berkshire Hathaway for 40 years was successful in redeploying the cash it took from its acquired businesses such as See's Candies and investing it in mostly other acquisitions. And this is a different model from Amazon, which invested in mostly internal projects. And Mohnish says that the prowess to redeploy cash is extremely rare. Number three was a question on foreign investments and the regulatory environment. And Mohnish said that he would sidestep talking about some of his current investments, but he observed from a blogger that in China, it's innovation and then regulation. In Europe, it's regulation and no innovation. And in the US, it's innovation and no regulation. So I thought that was kind of a funny quip and summary about how it's like to invest throughout the world. In addition, Mohnish shared his insights about the for-profit education sector in India and China, and they're going through some similar amounts of controversies, because he says that he looked carefully at the for-profit sector and studied it for years, and there's no easy answers, because he said when you have a system where there's a limited amount of seats into universities and a lot of families want to give their kids the best resources and tutors and everything to be able to get into universities, it leads to a system of ruthless capitalists who are going bananas in saying that they're the toll bridge where they can help increase the odds of these kids getting into competitive universities if you pay them, and then they tutor your kids, and then thereby they might get into schools. But then what they realized in China was that a lot of families were starting to change the math on how many kids they'd like to have, because they realized it was so expensive to get their kids these expensive for-profit education tutors and resources. So that was not really what China wanted their country to be going towards. So that's why they decided that the education would be nonprofit in China, and that caused a lot of the for-profit companies to kind of dwindle in their market cap and suffer as a result of this regulatory change. And he said that with India, it's a tough situation as well, and there's no easy answers. You either have to increase university seats or give people other avenues to pursue in terms of their career and educational needs. And then he said that a lot of the big tech players in China are very high quality, and he said that it's healthy for China to have a very robust competitive environment. And he said that these companies didn't break any laws, and some of these tech players were operating in a Wild West type of environment where they were doing what was considered acceptable in that type of Wild West until the Chinese government intervened and decided what's best for the economic ecosystem. Number 4 is finding great payment systems abroad. And Mohnish said that the payment systems are advanced in China and Korea, and the US is behind, where there's high frictional costs and it's an archaic system where Visa and MasterCard have entrenched moats, and consumers get kickbacks in the form of, he said this in a funny way, where we have IV drips of airline miles, but there's high frictional costs in which they're charging merchants 2 to 3%, and this is not the case in places like in China. And so we have a long way to go in advancing payment systems in the US. And he also said how it's a moving target, and even though the likes of Alipay and Tencent Pay have established some great moats, it can rapidly shift. Number 5 are lessons learned from Coca-Cola bottlers and their moats. And he says that Coke bottlers are given a territorial monopoly where they don't have to compete with other Coke bottlers in their region, maybe only have to compete with Pepsi bottlers. And he says that this type of business can be extremely poorly managed, but they can afford to have this kind of slack because you can have an idiot run this type of business and it will endure because it basically has a monopoly in place. So there's a running joke with business owners that they say when they're on their deathbed, they tell their kids, whatever you do, don't let them change the contract. And then this continues on throughout the generations where they hold on to that Coke bottling contract for as long as humanly possible because it's such a good monopolistic business. And he says that most of capitalism is not like that. It's actually more dog eat dog, where you have to have businesses really well run in order to survive. And he says that you don't have a lot of businesses that are in a very favored situation whose moats are very wide and deep, and they can endure with high returns on equity for a long time. Number 6, you have to love the hunt. And what this means is if you're starting out with small amounts of money to invest, you have to be successful at this for many years, compounding your wealth until you graduate onto newer levels. And so to put some examples behind this, he cites Charlie Munger's cigar butt investment in Tenneco, where he bought $1 worth for only 30 cents. And he says that you can't be buying companies that have already reached 80% of their intrinsic value. Otherwise, you won't achieve what is something that Joel Greenblatt said, where let's say you have $1 million and you can compound 50% at that amount. And if you've already invested in something that's reached 80% of intrinsic value, that might only give you maybe 20% of a return and not 50% in the Joel Greenblatt example. And as you become successful at investing $1 million at 50% per year, you might grow bigger to reach maybe $10 million, and then you can't invest that at 50% per year anymore, and you might be happy settling for only 20 to 30% compounded annual rates of return. And then you've left that arena of $1 million and you leave that for new entrants who are entering the lower end. And this can be for anyone who's young and enterprising and really hungry for the hunt to achieve more. And with Mohnish Pabrai, he says that let's say he has $750 million of assets under management. He can't invest in something that's a $2 million opportunity because that doesn't move the needle for him anymore. So for him, as much as he loves the hunt, he has to move on to something that's worth his time. Number 7 is finding winning tickets. And Mohnish starts this by saying that after the age of 5, people's inborn traits are frozen, and that who we are and our likes and dislikes and traits are hard-coded. So he talks about Warren Buffett's traits and how at a young age, Warren Buffett would go to the Ak-Sar-Ben racetrack, and Ak-Sar-Ben is just Nebraska spelled backwards. And Warren Buffett would find tickets that a lot of people had thrown away, and then he would go through them to see which of them were winners, and he would have his aunt cash them in for him. And then by age 25, Warren Buffett would go through the Moody's manual twice and find companies that had similar discrepancies and would be winners, such as an insurance company that was having a market cap of only $15 million, but had earnings that year of $25 million. So that was an outlier where it was clearly a winner for Warren Buffett to be able to invest in. And then by age 80, Mohnish said that he visited his office and noticed that Warren was going through the Japan company book. And even if there weren't opportunities that could move Berkshire Hathaway's needle in terms of investments, maybe Buffett might invest in them in his own account because he just loved the hunt so much. And so in a similar way, Mohnish Pabrai visited Turkey in 2019 and found a company that had a market cap of $20 million, but their liquidation value was $500 to $600 million. So he said, hallelujah. And Mohnish said that he was willing to pick up tickets where in a country of 80 million people, they weren't willing to. So he was more than happy to do that. So Mohnish said, this is the nature of the investing game, where there will always be Ak-Sar-Ben tickets on the ground. And the question is, will you bend down and pick them up and make some effort to analyze them? And Mohnish also summarized this by using a quote from the Upanishads, in which it says, "You are what your deepest desire is. As is your desire, so is your intention. And as is your intention, so is your will. And as is your will, so is your deed. And as is your deed, so is your destiny." So basically, Mohnish is saying that whatever our will is and our destiny is what we will be doing for ourselves if we go through a similar exercise of trying to bend down and pick up tickets that others have tossed aside. Number 8, we have to go deeper than what stock screeners might tell us. And Mohnish says that he cringes at mechanical filters like stock screeners because he says he doesn't think it's a very good approach and the real world is messy. Like he says, if a company is trading well above or below its book value, it may not really be worth its book value. So that's not really a true measure of maybe what a company is really worth. And he says that maybe sometimes some companies deserve to have a low PE ratio like a number 2 because in 3 years it might not be there. And he says that when things seem statistically cheap, that's only the beginning of the hunt. And then we have to see if it's within our circle of competence. Number 9, so you want to start a fund. And before you start a fund, for 10 years, you should be able to prove that you can generate 50% compounded annual rates of return. And so if you start with $10,000, you should be able to achieve 30 to 40 to 50% CAGRs for that period of time. And then you've got an engine using the power of compounding that will get you those high rates of return. And he quotes Warren Buffett in saying, if you've got a great track record, then people will swim in shark-infested waters to get you to manage their money. And he says that once you're independently wealthy, then you can go to family, friends, and especially fools to raise funds to invest with. And he says that when he started his fund, he had $1 million from 8 investors, and then that gradually grew to 17 and then 25 investors. And he says that one thing to understand about humans is that most humans don't know why they're on Earth and they're looking for a mission. So he told his initial investors that their mission is to get assets into the Pabrai funds. And he did this because the SEC has some strict rules with funds and that they can't advertise, but he says that it can't stop him from talking with his current investors. So that's why he told them that this is your mission, is to get more people to contribute their assets that Mohnish could invest. So that was a very clever way that Mohnish focused on being independently wealthy first, and then he was willing to open a fund after he had some success telling people some stock tips, and then they were coming to him to actually manage and invest their money. Number 10, Fiat, Chrysler, and Ferrari. And once upon a time when Mohnish Pabrai owned Fiat Chrysler, they spun out Ferrari. And so he had equal amounts of shares in that, which was something like 1% of Ferrari was owned by Pabrai funds. So every 100 Ferraris sold was to the benefit of Pabrai fund investors, and he regrets selling Ferrari when it was trading at 30 to 40 times earnings. And he says that in his infinite wisdom, he was overly focused on companies with a PE of 1, and he's clearly making fun of himself because it wasn't really wise of him to sell Ferrari at all, knowing that, say, $100 million investment in Ferrari would have grown to $300 million by now. So he clearly wasn't thinking in the long term, what's the final destination for a company as good as Ferrari. And he says that Exor is a very good capital allocator, and the chairman of that is John Elkann, and he's very good friends with him. And John Elkann is also the chairman of Stellantis. So all in all, Mohnish Pabrai is probably longingly wishing he still owned Ferrari, but he's probably okay with letting go of Fiat Chrysler, which merged with Peugeot. Number 11, last questions on a contest and books. And Mohnish Pabrai has an investment in Suntech Realty, which is going up against his friend Guy Spier's investment in MasterCard. And this contest is still ongoing as to who will win out. And Mohnish says that back when he made that bet, he was more biased toward PE of 1 type companies, and now he's way more biased toward compounder companies. And so he's not sure if he would make that same bet again today. And then when it comes to books, Mohnish says that Zen and the Art of Motorcycle Maintenance had transformational value for Nick's sleep, but it doesn't look like it had that same impact on Mohnish Pabrai. And instead, Mohnish Pabrai especially enjoys autobiographies and biographies of successful investors and entrepreneurs. And he says that he learned from Jim Senegal, who was the founder of Costco, who had learned from Price Club founder Sol Price. And right now he's reading this book by Jeff Bezos called Invent and Wander. And that's the extent of what Mohnish Pabrai covered in some of the last questions that the Brown University student had for him. And if you enjoyed this video or learned something, please like and subscribe. And I hope these takeaways were just as helpful for you as they were for me. And I wish you well on your journey to being the best investor you can be. Till next time.